Good day,
What
good
up?
day, good day.
What's up? What's up,
It's your girl, Mercedes Erhahon,
Brian?
with RESWealthy Talk.
RESWealthy Talk here, bringing it to you in a candid fashion, having a conversation about all things real estate, mortgage, and just how to navigate in this environment and making the best decisions possible for you and yours.
Amen, amen. So we'll be talking all things real estate, what's happening in the market, not so much the headlines, what actual and is factual. I think one of the things that we'll also be doing
Factual.
is separating national trends as well as what's happening in Southern California. We keep reiterating this. Cali is its own ball game. So first, we'll be talking about sales and volume. So Brian, biggest question that I think people are having is: are home sales collapsing in America? And we have a chart here right now that'll show you how everything's going annually too.
I mean, home sales, right? I mean, home sales collapsing. I mean, I think like, what does that mean? Home sales collapsing.
That's all you hear. The sky is falling. The sky is falling.
You know, what's interesting about that is, although we're seeing a bit less velocity in sales closings, on a weekly, monthly, or annual base, we're still not seeing that translate to a reduction in pricing. And so when we see that, it it creates the almost false narrative that things are worse than they are. And I think people overreact to that. And really, all we're mostly seeing is people are just, well, buyers specifically, are being a bit more selective in the homes that they're deciding on purchasing. And a lot of that has to do with affordability. A lot of that has to do with home prices and interest rates. Although interest rates have started to settle down, they haven't really made as much of a difference yet uh, in people's pockets, right? In monthly payment.
So what I'm hearing you say, for our listeners, seems like we're just coming off of an abnormal spike, right? Think what people are feeling is actually getting back to a balanced, even market versus what we've been seeing, in the last few years during COVID.
Yeah, I mean, I think that, when we're talking about, balanced market, that just goes to, the market doesn't favor any one party, whether it be buyer or seller, right? So, and now this is all based off of average price point, or, on location and area. And yet what we see is that the the buyers who are in the market, it's a black or white. It's either you're priced well and it makes sense for them to purchase what you're offering as a homeowner, as a seller, or if it's not priced well, then they're okay just letting it sit. Buyers would rather not make a decision than to make a bad one. And so, meaning they would rather not pull the trigger and purchase a particular home than buying a home that's going to cause them financial duress. And that's what we're seeing. Folks are like, you know what, this home doesn't really, yeah, although it may check the boxes and it makes, it's got everything that we're looking for, yet it's really not. It's not checking that financial box to where I know I'm going to be moving myself. I'm confident. I'm certain that I'm going to be moving myself financially forward with this purchase.
So
What
just being more strategic
strategic
and level-headed.
and level-headed. So the most purchase transactions right now are less about emotions and more about logic. Buyers in buyers markets typically think more logically than emotionally. Now you'll get your, your typical, I've got a growing family, and I'm tired of this 2 bedroom, gotta go, and it's time for me to go. Or I've got a job relocation that has to happen, and I've got to just get it done. Obviously numbers still matters in those situations. Yet most people today are saying, hey, well, look, I'm okay just staying where I'm at. I don't need to buy. I would like to buy. And so because I would like to and I don't need to, I would I want to make sure whatever I'm purchasing makes the most financial sense for me. So, when it goes back to your question about the velocity, or your thought about the velocity of sales, or our home sales collapsing, we really got to look at zoom out a little bit and look at perspective. So, when we're gaining perspective on just in sales in general, and we got to go back to go back in time quite a little bit. So when you actually look at this chart here, right, this is the annual home sales over the last, call it 3 decades, going on almost 4 decades, right? And so when you look at this chart, the annual home sales, when we go back to the idea of, is it a collapse? Not necessarily. We've been at this point multiple times before, as far as the amount of velocity of home sales. And so you go from 2021, 2022, um, it starts to come down. However, the typical home sales is about anywhere from 5.1 to 5.5 is roughly the average. So the annual amount of closings, and that's really what it is how many closings are happening throughout the country every year. And so the last few years we've kind of been, when you go from the high of 2021 and you look at this chart here, we're down to about 4. Last year we dropped to 3.9. That's
So
about 50% less homes sold on an annual basis compared to the COVID high, if you will.
yeah, we peaked during COVID about 6.1.
Hmm.
And so being now down to about 4 to 4.3 million feels tight. However, as Brian mentioned, we're just normalizing.
Yeah, I think it's the, not to say correction yet. It's what we're seeing is that half of all mortgages out there also are at 4% or less. So you've got a bunch of people who are like, why would I move when I have a less than 4% interest rate? I can't get that back. It would take another global correction or a pandemic, for that to happen, or global more so crash, right? That's what happened if you look at that drop down in '08, '09. When you look at going from, in 2005 we're at 7.1, and then in 2006 we're at 5 million, and then 2008, by 2008 we hit that 4.1. Just for reference, last year they said it was about 3.9 to 4 million homes sold. So that's actually the lowest on record for the last about 30 years,
Which is wild.
which is wild. Now, here's the thing that I think people also need to consider is that home prices haven't dropped like crazy. So how this time is different from last time, what we know is that basically, folks are still, we're still kind of flirting around with the record highs in some cases, when it comes to home prices. So if we go back to '08, prices dropped off a cliff. Right now we're not seeing that because we don't have record foreclosures, we don't have record short sales, we don't have people losing their homes left and right, not in this case. And you have a record amount of people with a ton of equity in their homes. There's never been more homeowner equity right now than any other time in history. The amount of equity in homes, it's crazy. I think there was a stat that I saw the other day. It was like 30 to 35% of all homes right now are paid off free and clear.
Wow.
So,
Wow.
you know, correction, I don't know. I don't necessarily, or price market crash. I don't know.
This is not 2008 territory. So just breathe, everyone, breathe. Just get that out of your head. We are just, normalizing,
It's just a slower pace of home sales. That's it.
basically.
That's it.
So, Brian, let's talk appreciation. I know you went into there, but I think there's a difference with national versus California,
Of course, there's always is.
and our price points, how we differ, and why some may be selling because they're full of equity, or some might be holding and having that as their retirement too. So nationally, the average is about 400, right? And then you come to California. Why are you looking at
I'm
me
waiting
like
for you to
that?
finish your sentence.
You always like to talk numbers. All right, our medium in California is about double that, about 800,000.
Yeah, about 850 or so, the median price. Yes.
And then you touch on luxury, we're at about 1 million on the medium price point, and that's like coastal, more coastal, right? And then Inland Empire, where we, reside, the good IE, we're about 600,000, right?
All right. So speaking of appreciation, yes, we know California appreciates better, and we see that the market here is a little different. We have lower inventory, and as a result of lower inventory, because we're you can't build along the coast anymore. So you can't build in LA anymore, right? You got to take down some properties to rebuild, and you have higher density properties, condos, townhomes. Very difficult for you to build true single family in LA, in
LA is
Orange
going
County.
this way.
You look at cities in Orange County like Irvine, they're starting to go up with split level housing. You're seeing that in Los Angeles. So we've
There's
got to
tearing
go
down single family homes
a
and
bit
building.
more east, right, where you can build. And so, we see more folks, migrating east. There is land there. However, the cost of housing in Metro LA or Orange County, it is what it is, and we're probably going to continue to see that rise. Now, when you look at the average trend, right, when as far as the long-term trend right now has been compounding about at a rate about 4% since the 90s. So when you see that blue line there, that blue line is the normal annual trend, and the pricing typically follows the normal annual trend. Now, as long as prices continue to appreciate the way that they've been, we might see that trend go from 4% maybe to 5%, and yet that's as a result of the overall past history of housing and how we're seeing appreciation happening. Now, we've started to see it slow, over the last couple years. So we look at 2025, there wasn't much gain over 24, 23, etc. Back in 2020, when you see that long-term trend, obviously prices were lower, but it started to tick up, after 2021. Now, all that to say, we got 7.4% above that annual 4% trend. This is in the last few years. At some point, though, back in '06, '07, '08, and then it started coming back down to that trend, we were 21% above that marker, right, in terms of pricing and appreciation. So
So currently we're above the trend, not below it.
we're above it. However, we're not above it at the level we were in '06.
Well, appreciation slowed down. I mean, 2 to 4%, which that's historically normal.
Yes, it's historically normal. Prices coming back down to that 4% trend that we've seen throughout,
I mean,
history.
the pandemic was double digits, like something
Yeah, but
nobody's
even
ever
but
seen.
even with that, it's still not what it was in '06, '07,
Right.
'05, '05. 21% trend is not the same, obviously, as 7.4. And folks today are like, oh, it's so expensive, and yet it's not as expensive, in relation to what we saw in '05, '06, right? Compared to
Right.
where incomes were, inflation at that time, all the above. So I think that's something interesting to be aware of. And I actually like this chart here. This chart actually gives us a bit more specific. How many times in the last 30 years have homes depreciated, right? Meaning going down in value. So this is about, let me look at this, 36 years.
Yeah, from
right? From
1990 to current.
1990 to current, 36 years. And over the last 36 years, home prices have moved backwards one, two, three, four times.
Between 2006 and 2011,
2006 and 2011,
four times
they
only.
they dropped, four times in those, call it 5 years. So four times in those 5 years. However, when you zoom out and you look at
Overall.
overall history, there's a lot that went on from 1990 to going into this year, 2026. Four times out of all of history in the last 36 years.
That says a lot. I mean, when the sky is falling, it's like it's not though.
Right.
It fell between 2006 and 2011. How fast forward to 2026? I mean, this is normal.
This is normal, and you can also see the moments of appreciation, right? And so,
So
and
the
then
peak,
right, the 90s to 2000 appreciation was about 3.9. That's the average appreciation. And then from '01 to '05, 8.9. And then 2006 to 2011, negative 4.4. And then from 12 to 19, 6.4. And then here you have, in just 2 years,
what a time to be alive.
12 and
20.
a half percent increase in that's where you get that overnight shifty, what in the world just happened? I thought prices were this, now they're that.
Yeah.
How does that make sense?
Yeah.
And that's where you get a lot of that, we call it, like sticker shock of, wait, what's my payment?
Yeah, people blinked and said, "I thought this house would be about 300,000-400,000." But
Yeah. Yeah.
where
And
you
then
been?
and then you couple that in with the next couple years after that, 2003 to 2004, 2005, with rates being higher, going from 4% to 8%.
Yeah.
That's where people are like, no way, something's got to give. And I understand it, where people are like, well, hey, I'm thinking there's got to be a crash. Utilizing crash, perspective or thought, when that's the easy thing to do versus understanding what really just happened.
So what do the kids say? The math, the math ain't mathing, the math is mathing. I say that to say data speaks for itself, and we just can't keep having these stories that we're telling ourselves that there's going to be a crash, because I'm telling you, the same people in the start of COVID who thought COVID was going to be a crash, and you see this 12.5% appreciation, wished that they would have bought then.
Always happens.
Always. So now the data trends are showing that that's not happening, and it's especially not happening in California. So I say this to say the time to buy is when you're ready, willing, and able. Otherwise, appreciation is just going to continue to grow. We're seeing appreciation, not depreciation.
Depreciation. So, this is also another good chart to really zoom in on, of what had to have happened, because now we go back all the way to 54, right? So that is, we'll call it 75 years, roughly about 70 years, yeah, about 70 years. And when you look over the past 70 years, there's been a few more times in history where you saw, negative appreciation, and yet not by much. And I think that's something worth really paying attention to, of, okay, what had to happen in order for you to see negative pricing or depreciation. So when we punch in here and we look at, okay, in the 50s, what happened? Eisenhower, right? Recession. He increased interest rates, and rates dropped by, average pricing dropped by 0.87. All right. We had the oil crisis in 73. Rates drop, or appreciation slowed to 0.67, 0.61. All right. And then stagflation of the mid 70s, prices jumped 11.8% in 75, 11.28. And then 79, 16%, right? Inflation on its way to an all-time high. and then you had the another drop from 79 to 82. Basically, this drop here is the slowing of appreciation.
Mhm.
And so so because this line here, this 0%, that's the midline of whether it's appreciation above the line, depreciation below the line, right? So it so far only one time from 59 to 91. So from 59 to 91. So it got close. It almost touched the line. However, there was still some sort of appreciation, 0.61, 0.57. This was a another recession, all-time rates increase, Fed rates all-time high at that point, right? And that brought appreciation down crazy. And then savings and loan crisis, -2% in 91. Okay. So when you look at, and then the Great Recession, -12.75. And then the Fed increase rates again 0.43. So one, two, three, four. Now there may have been some multiple within like a year or two here and there where it continued, but it wasn't a major drop. So when you look at the group of years, maybe this was a tough 2 3 years, right? And then out of it, and then on. So it wasn't meaningfully a meaningful drop though, right? So when you look at over the last one, two, three, four, over the last 70 years, there's been about four moments and or four situations that cause homes to hit negative territory. And the worst one was the Great Recession at a -12%. So people remember that moment, and it was the worst moment in history that we could see, and that's justifiably so. And they're like, "Oh, it's going to happen again."
We're in 2026.
Well, I mean, it's not far. It's not that far ago, and yet, it's one of it's the last major event that occurred that folks were like, "Yeah, that's a bit." And by the way, though, that drop from 22 to 23. People were like, "Okay, it had to happen, right? Fed had to increase rates because otherwise, folks weren't going to be able to see housing as an option, period." And so when we look at this, there's there's some things to learn from it. What had to, and I look at this chart, and Mercedes, I want your thoughts on this. Like, some things have to go down. Some global type stuff has to go down in order for us to see homes crash.
Yeah. And we're just not having forced selling right now.
Yeah.
And there's nothing going on there. So I mean the collapse math, it doesn't work here.
Not here, not right now. Now, here's the thing. My friends, I say this with a whole heart, and and saying this, honestly, it's like a double-edged sword, frankly, because when in order for rates to come back to where they were, you've got to have people either massive loss of either economic or life. Some crazy, world war type,
So be careful
pandemic
for.
type, right? Global meltdown, recession type. Folks may say, hey, I'm waiting on the market to crash. You're like, okay, you're also waiting on people to either die or
Lose
lose
their job, which that
lose
job loss could be
ma-
you.
massive job loss, and homes given back, right? Foreclosed on.
Nobody
and
wants
and
that.
we can't foresee that. So in a lot of cases, we don't want to foresee that because we don't know what that next situation might be. A lot of people, attempt to run off a crystal ball, and yet, a lot more people would have been extremely wealthy if everyone saw the Great Recession coming,
For sure.
or more people saw the Great Recession coming.
For sure.
Same thing with COVID. If everyone knew that COVID was going to turn out the way it was, or it did, folks would have bought more. We would have bought more property, right? It's very hard to it's very hard to think in however many years ahead when you're living through the moment,
Yeah.
particularly that moment of loss. So you got to be careful what we wish for. Yeah, the market's going to crash. All right. Yeah. At what cost though do you want to buy a home? You know,
And I think, to have a moment of emotion right now, don't feel like we're beating you up when we're discussing not buying in, during COVID time. There was actually so much going on in everyone's life.
yeah,
Mentally, physically, people were dealing with people passing away in their lives or job loss or
mental health.
just mental health breakdown. So I want to be clear that, this isn't a moment to beat you up or make you feel down. This is truly a moment of awareness, right? And to really just not hone in on the past of, '08 and being stuck in woulda, coulda, shoulda of during COVID time. It's a time to come to realization of, if I don't get in now when I can, what does it look like when I can't? And then you sit back and wonder, was I just stuck in a rotation of the hysteria that's, in the market versus, I'm sorry, in the news, versus just really trusting myself and, the professionals on when is a good time, right? And we're always going to lean into the good time is when you're ready.
That's the most important thing. The best time to buy a home is when you're
When you're
ready,
ready.
able, and willing. When you see that payment, you're like, okay, I can do this. I may not love it, and yet I can do this because affordability comes. The next best time for your home to be the most affordable versus right out the gate when you purchase it is going to be when you have time in, right? It's going to be after 5, 7, 10 years when you're starting to knock down principal. You've knocked off the mortgage insurance if you started with it, or you're in your home and then you have one of these situations happen, and your job situation is still fine, and you're like, you know what, I can afford to not necessarily take advantage yet. I can afford to get my rate lower because this is going on. My job's secure. My situation is fine. All right, let me go ahead and knock my interest rate down because I have time in. So when you have your principal reduced and your situation is going from, I have, I started with 5% equity in the home, and then over time with a 4% appreciation compounded over 5, 6 years. All right, now I'm down to I have 20 to 25% equity. I can knock off my mortgage insurance. Oh, by the way, I can refinance because my mortgage debt is lower and my interest rate, the quoted interest rate, is lower than what I currently have. Now I just knocked off $700 off of my mortgage rate. And then you might get to a point to where you're like, you know what, I don't really want to go any lower on the payment. I can actually decide to refinance into a 15-year mortgage because my situation is fine. I'm pretty sturdy. All right, 15-year mortgages offer lower interest rates. Let me go do that. And in some cases, sometimes there's really no advantage to refinance into a 15-year mortgage. Some might like the flexible feeling of that payment, and they'd rather just let me make 2, 3 more payments per year to get that same feeling I'm having a 15-year mortgage.
Leverage that equity to buy something else.
Yeah, and that's also an option as well, especially if this is not your forever home. So, where do we go from here?
Where do we go from here? I mean, so Brian, if oversupply is not slowing people down, what do you think is? And one of the big things I think that we keep hearing and seeing is rates and affordability, right?
Yeah, I mean, I said it a little bit earlier. When you look at the breakdown of really what's going on, there's just so many people that have a really good interest rate right now. It's just like, why would I do anything else with this house? I'm in a 4% situation. You know, I'm keeping it, and if I moved, I would be in a situation where I'm paying for more, right? I'm paying more than I need to. Why would I move and live in a situation where I've increased my mortgage payment and I may or may not like the home anymore, right? So when you look at this, right, when you look at this chart here, you know, you see that there's about half of all homeowners have a mortgage rate 4% or higher, and then the other half have a mortgage rate of 4% or less. 51.5% have a mortgage rate of 4% or less right
And
now.
that's that locked in effect that, we're seeing when people are like,
Mm-hmm.
well, why? Why would I?
And what's here, what's not here is the percentage of people who don't have a mortgage, period. Right. So when we see why prices are still semi up there, it's generally because there's not a crazy amount of homes on the market for buyers to have so many options that prices are falling.
I think, another important factor of, affordability is, the PMI and income. I know you talked about it, but we didn't talk about it in percentage rise, right? So principal and interest payments are consuming roughly 32 to 34% of income nationally. That's super, super elevated. And what does that do to the market at that moment? When people see that and hear that, they're like, I can't have all my income tied into a property.
Well, I think that okay, so you bring up an interesting point. And in order for us to really get an idea of what's happening with affordability, we've kind of got to go back to where are interest rates.
Mm-hmm.
And so when you look at where interest rates are, you also got to look at where they've come from. And at one point, interest rates were at 16% in the 80s, and people still bought homes. Like
it was nothing.
if we go back, so I'd be curious. I don't think I have that chart, but if we go back to how many homes were sold back in the 80s and whatnot, I mean, there's still homes being sold there in 16%, 18%, right? And so now, one line that I want to pay attention to is that light green line. So from 72 to now, the average interest rate has been 7.72%. Where are we right now? We just dipped below 6. We're technically like 5.99 something, right?
Projected, yeah.
So we're already below the average interest rate since the 70s.
And yet, why do you think the consumer is just stuck to COVID?
Well, it's just it's our frame of reference, right? Why would I want to get a 7% when I saw 33, my best friend or my coworker has a 3.75?
It was an anomaly.
And then folks are, ooh, you got a 7%?
We're not helping. And
right.
then you have, I don't shoot the messenger, but the boomers, the baby boomers, right, that purchased and had 18, 20%, they laugh at all of this, at all of us. They think we're spoiled. It's like, get off the pot. What's that saying?
Shit or get off the pot.
He said it, not me. So we say that to say, I mean, right now you're rocking with an average rates right now. It's nothing crazy. It's not 18%.
Well, the reason why people are feeling that, going to your question about affordability, when you look at your principal and interest payment as a percentage of your income, we're at roughly 32% right now. The average over the course of the 70s has been about 27%. The lower, so historical average from 2000 to 2024 is 20%. But then that almost don't count because you have COVID in there. However, if you go all the way back to 72, then you're at 27% of principal and interest as a percentage of your income. And today we're at 32%. But when you go back to 81, half of people's income went to mortgages,
Went to housing.
principal and interest. 49%, and they survived, right? And then look what happened over time. When you're in a home long enough, when you're in a home and you're in property long enough, you see the benefit. Now, here's the thing, though. The way that somebody wins in a home versus not in a home is that when you go from 49 all the way to 92 or sorry, 49% all the way down to call it 27%, that maybe so from 82 to 90 something, that's 8 to 10 years. Imagine how much debt pay down that person that's been in a home has now. Imagine how much their home has appreciated as a result 10 years from that. We just looked at the numbers that there's only been about four major times in history where interest rates or when appreciation dropped, right, over a course of multiple years. So when you see this, you're like, well, okay, that person that was able to get in based off their own personal economy and their own ability to afford their mortgage payment, even though it was half of their income, they stuck it out. Their situation just got better.
Yeah. I mean, that's the message that I think we really hone in on to, convey. If you're comfortable and you can afford it, get in.
And then over time, it just only gets better. Only gets easier. It only gets more affordable the longer you're in that property.
Because the latter is you continue to rent, go up 5% every year. That's a cost that you can't fix in, unlike your mortgage.
Yeah. So, this is just a really good chart to have some perspective on. So I think that wraps it up when it comes down to appreciation. Mercedes, what are your thoughts when we look at all that?
This is not a housing crash cycle. I don't know how many times.
We're just knocking it down. That's a crash. That's a crash. We're gonna leave that in. That's a crash.
That's a crash. The market's not crashing.
Yeah.
So, I mean, it's a rate shock recalibration cycle. I would say it's more of that than a housing crash, Brian.
Yeah.
I mean, sales have normalized, prices have stabilized, inventory is tight. It's even more tight in California. And I really want because we service Southern California, I really want our people to really understand the numbers here in California versus national. We're in a whole nother world here. However, good news is equity is still strong. You get in now, you have your retirement plan.
Yeah. Well, there's a lot of folks who use that California home as a cash down payment for their next place out of state.
Time and down. I mean, we can go into how many clients we've had that sold in California. We're able to buy all cash in another market area. So it's really our SoCal people. Stop playing. Stop playing.
Stop playing.
Markets, they move in cycles, and this cycle is not a crash.
All right. So with that being said, hey, thank you for tuning in to another episode of RESWealthy Talk. As always, our success is based off of your willingness to like, share, and subscribe. So with that being said, have a great rest of the day and tune in for our next conversation, RESWealthy Talk.